What is money laundering? Money laundering involves disguising the proceeds of illegal activity as legitimate funds by moving them through a series of transactions or businesses. This process is used by criminals to conceal the illegal source of their income and make it appear as if it was earned through legitimate means. The need to launder money. Criminal organizations, such as drug smuggling operations, often face the challenge of hiding large amounts of cash obtained through illegal means in order to avoid attracting the attention of law enforcement. These organizations also seek to avoid acknowledging the illegal proceeds as income in order to avoid paying significant income taxes. To address these issues, criminal enterprises engage in money laundering, a process of disguising the illegal origin of the funds by integrating them into the legitimate financial system, such as through banks or businesses. Essentially, money laundering aims to make illegally gained money appear legitimate. How money laundering works. Money laundering typically occurs in three phases. Initial entry or placement is the initial movement of an amount of money earned from criminal activity into some legitimate financial network or institution. Layering is the continuing transfer of the money through multiple transactions, forms, investments, or enterprises to make it virtually impossible to trace the money back to its illegal origin. Final integration is when the money is freely used legally without the necessity to conceal it any further. Money laundering example. A common and relatively simple way to launder money is to channel it through a business with high amounts of cash transactions, such as a restaurant. In fact, the term money laundering originated from the practice of gangster Al Capone using laundromats he owned to clean large amounts of cash. The money laundering process usually goes something like the following. 1. Initial placement. A criminal or criminal organization may use a legitimate restaurant business they own to launder money obtained through illegal activities. They do this by gradually depositing the illegal funds into a bank through the restaurant. For example, if the restaurant actually takes in $2,000 in cash in one day, an additional $2,000 from illegal activities will be added to that amount and the restaurant will falsely report that it took in $4,000 in cash sales for the day. This deposit will go into the restaurant's legitimate bank account and appear as a normal deposit of restaurant proceeds. 2. Layering the money. To avoid attracting attention from tax authorities and further conceal the illegal source of the deposited funds, the restaurant may invest the money in a legitimate business such as real estate. This layering process may also involve using shell companies or holding companies to control several businesses that the laundered money is funneled through. This can involve passing the money through multiple transactions, accounts, and companies, such as through a casino to disguise it as gambling winnings, going through foreign currency exchanges, investing in financial markets, and ultimately transferring the funds to accounts in offshore tax havens where banking transactions are less closely regulated. The multiple transfers from one account or business to another make it increasingly difficult to trace the money back to its original illegal source. 3. Final integration. In the final phase of money laundering, called integration, the laundered money is placed into legitimate investments or used to purchase luxury goods such as jewelry or cars. The goal of this phase is to make the money sufficiently clean so that it can be used freely without the need for any further illegal activity. The money may also be used to create another business for the purpose of laundering future illegal funds. At this stage, the laundered money is typically invested legitimately or exchanged for valuable assets such as property. Thank you for watching. For more fascinating facts, please like and subscribe.